So in the last session, we completed the cost of equity. We learned how to find the cost of equity using the two methods, using the dividend valuation model and using the capital asset pricing model. So we have these two methods, right, that we mainly use to find the cost of equity. Our objective was to find the cost of capital. Okay, we are basically focusing on how to find the cost of capital, our weighted average cost of capital, right? So to find the cost of capital, first we have to find the cost of equity, then we have to find the cost of debt, and once we have both cost of equity and cost of debt available, only then we can find the cost of capital, our weighted average cost of capital. So cost of equity, we only have two methods in our syllabus. Mainly, we have these two methods. For cost of debt, we have many methods available. Why? The reason is because equity, there's no grading in equity. There's no classes in equity. I mean, look, if you buy the share of Apple, I buy the share of Apple, Amar buy the share of Apple. So we all are the same grade of share, same class of share. You cannot say, okay, his risk characteristics for the Apple share is different than me. No, it's same. Look, when you are shareholders, the ordinary shares are same in characteristics, are same in class. They have no categories, they have no classification, isn't it? For ordinary shares, we have no classes, we have no grades. But for debt, we have, right? We learned that we have different means from where we can arrange our debt. We can go with a bank loan, we can arrange our finance through bonds, loan stock, loan notes. And even in the bonds, we have many different types like irredeemable bond, redeemable bond, convertible bond, variable bond. All of these bonds have different characteristics, different features, different maturities, different risk characteristics, and then preference shares is also having different risk characteristics. Since they have a different kind of nature of securities, so we have to find different ways to find the cost of debt for these, right? So we will learn today how to find the cost of debt for the bank loan, how to find the cost of debt for the bonds, and how to find the cost of debt for the preference shares and so on. Okay. First of all, I will start with irredeemable debt. I mean, if a company have issued irredeemable debt, like irredeemable bonds, a loan stock, if you have issued, then what is the way to find the cost of debt is very similar kind of a formula that we use, which is closer to dividend valuation model. The original formula was this: P naught cost of debt we denote with KD, cost of debt, right? I over KD. Look, what is the irredeemable bond? You remember? Bond that has no life, no date mentioned on it, undated. So they will give you a fixed interest in perpetuity. Look, so if you want to find the market value of the bond, by the way, this we are going to do in our next section, our section F, which is a business valuation, right? So if you want to find the value of the bond, that's a formula. P is equal to I over KD. What is P? P naught. P naught is the X interest market value of the bond. Remember? Right? Sharma, remember? We discussed about it. Bond also have a market value, just like share has a market value. Bond also have a market value. And in last class, I discussed this thing with you the best way to find the value of something is just take all the life cash flows of it and discount it. So what is irredeemable bond? It gives you only the interest, and it gives you interest in perpetuity. So take the interest and multiply with 1 over R. You can also call it R. Look, what is KD? Return. Okay, so what is the formula of perpetuity? Look, if I multiply with the perpetuity formula, same thing. So now if I want to find the cost of debt, I have to revise it. Simple. I have to revise it. So when I revise it, what answer I will get if I want to find the KD? Okay, the formula is I over P naught. There is a formula we are going to use for the irredeemable bond. Okay. But here we have one thing. Look, in equity case, the cost of equity and the rate of return of the shareholder are same, right? I mean, what you find using CAPM or what you find using dividend valuation, it's the same cost to the company and same rate of return of the shareholder. But here it is not a case. How? Due to tax relief. Look, let's say we borrow money through bonds or through bank loan. What we will do on it? We will pay interest on it. Interest results into reduce in our profit. And my profit will reduce. What will happen? My tax will be saved. Okay, let's think about two companies. Let's say we have two company. We have company and they have same earning, let's say. Okay, let's say we have two companies. One company name is company A. And other company is company B. Okay, the profit before interest and tax, PBIT, or operating profit. Let's say the operating profit is same. Let's say 10,000. And it's also 10,000. Company A mainly financed through debt. So they pay interest on it. Okay, so interest is a tax allowable expense. So interest, let's say they pay interest of, let's say 4,000 of interest they pay. Company B is purely financed through equity. They have no interest. They only pay dividend. So dividend is not deductible here. So how much PBT you will get here? 6,000. They have 10,000. How much tax they have to pay? Let's say tax rate is 50%. They have to pay 3,000 tax. They have to pay 5,000 tax. So look, they have the same operating profit. Both the companies have the same operating profit. But company A pay less tax because of the finance through debt. Okay, so how much interest they pay? 4,000. But how much they save? 2,000. So effectively, how much interest they pay? Just 2,000. Look, they pay 2,000, 4,000 interest. But they save in interest of 2,000 here, save in tax of 2,000 here. So effectively, how much saving they made? Half of it. So what is the way to find this directly? Look, by the way, here investor receive entire 4,000, but we pay 1 minus T. Okay, this is a way to find the effective interest. Okay, we give 4,000 interest, but 50% we save back. So effectively, how much cost we pay? How much investor receive? He get full, but our cost is half because 50% was the tax rate. If tax rate for, let's say, if tax rate is 30%, okay, then how much tax in that case? Look, so if tax rate is 30%, so 6 3s are 1,800 here and 3,000 here. So how much tax we save? 1,200. And if I want to find in this way, 4,000 into 1 minus T. T is 30%, right? So 4,000 to 0.3. 0.7. How much you get? Huh?
2,800.
That case, how much interest you pay effectively? Look, you pay 4,000, but 1,200 you get benefit. Effectively, the company pay how much interest? 2,800. But how much investor receive? 4,000. That means in that case, because of this tax saving, the required return of the bondholder is not same as the cost to us. Our cost is much cheaper than that. What is the required return by the debt provider? So formula we are going to use to find the KD here, interest over market value of the bond. What is the cost to the company? Look, company will get tax saving. So in that case, formula is the same, but I will do 1 minus T. So what conclusion we draw from here? If examiner asks you to find the cost of debt, add 1 minus T. If the examiner asks you to find the required return of the bondholder, don't add 1 minus T, because they will get the full tax saving we will get. That's why the cost of debt is cheaper. Look, simply the pre-tax cost of debt is the required return of the investor, and post-tax cost of debt is the cost to the company. Okay, so can we do it? And remember, once again here, P naught stand for X interest market value of bond. He might give you cum interest market value. So use the same methodology we learn in dividend valuation model. If he gave you cum interest market value of the bond, subtract the interest amount to find the X interest market value. So basically, I is the coupon rate. Look, this I, how you find I? Look, we will find I in dollar, not in percentage. Look here, I stand for, let me write down here. Here I stand for interest amount, not the interest rate. Here I stand for interest amount. And how you will find the interest amount? Okay. Always remember, interest you will pay based on the coupon rate multiplied by the par value. So in bond case, always assume par value is 100. The formula to find it is coupon rate, whatever the coupon rate is there, and multiply by par value of the bond or face value of the bond. Look, don't do it by multiplying with the market value, because market value will keep on changing. So you will pay the coupon based on the par value, face value. In this case, if I want to find, it's very easy. So 10% is the coupon rate, and the par value, if it was not mentioned, always assume is 100. So $10. So my I is $10. And second thing is the market value of the bond. Quoted mean trading. So we need X interest market value. If it's not mentioned, we believe it's X interest. Okay, so divided by 80. So what answer you will get? This is the return of the investor, 10 over 80. 12.5? Okay, so 12.5 is the answer for A. Can you find the answer for B? $9.75. You told me, I don't know. 8.75. Okay, should I check it?
8.75.
Okay, fine. So look, from here, what we learn, The investor will receive the entire 12.5% return, but our cost is just 8.75% because of the tax saving, because of the tax relief. Our overall effective cost will fall. That is why one of the reason your debt is always cheaper, right? Moving on. Yeah, can you try this question? 13, 14 very quickly. Okay, do 14 very quickly. So we have to find again both. The required return by the debenture holder and the cost to the company. Simple. Should I do it? Yeah, first one, required return. So simply you will do interest amount over P naught. No 1 minus T. Interest amount formula is par value into the coupon rate, right? 12. So $12 divided by the market value is 92, but it's come interest. We need X interest. So 92 minus 12, $80. So it will give you 15%. When it comes to, this is part A. When it comes to part B, where you have to find the required return of the cost of the company. Of course, company will save the tax on this interest. The formula will be this. So $12 into 1 minus tax rate divided by 80 or 0.7, just multiply with it. So you will get the answer 10.05%. Okay, so we learn in case of irredeemable debt, that is the way to find the cost of equity, cost of debt, and the required return of the bondholder. Which one? 0.33? Okay, 0.33. You have to 0.33. Yes, it's 33%. Yes, it should be 0.67. 12 multiplied by 0.67. Now, what about the redeemable bond now? Okay, for irredeemable bond, because they gives us the same cash flows in perpetuity and they have no redemption, so we use the simply perpetuity formula to find its market value and then we reverse it. Redeemable bond, remember, it has a maturity date, it has a redemption date. So we also need to include its redemption amount as well, right? Sorry. Right now, I'm talking about redeemable. What we have discussed, that was for irredeemable bond that has no maturity, no life. We can call them undated bonds as well. Now we are talking about redeemable bonds, a redeemable debt, those debt that has a maturity. Look, so for redeemable debt, we need to consider, first of all, their three cash flows. They have three cash flows. First of all, you have to take all of those three cash flows. To find the cost of debt of redeemable debt, first you have to take the three cash flows. Which three cash flows? Number one, the market value. The market value of this bond today, the P naught. The same P naught we need there, right? Okay, then second thing, interest. Amount. Right? Which is what? I. You have to find the market value. You first of all need to figure out these three things: market value, interest amount, and redemption amount. It will be given. Redemption value or redemption amount. What that mean? This bond will redeem at what amount? It will be given. It will redeem at par, or it will redeem at 10% above par, right? Then what will be the redemption value? 110. So we need to figure out this. And we also need to find the life of the bond. So we have to take these three cash flows, and what I will do, look here. Let me do it. Yes, I will take all the cash flows. I will consider market value of today, year zero. What's the market value of the bond? Let's say the market value of the bond which is trading today is, let's say, it's trading at 105.9. Let's say is a market value. Okay, the bond life is, let's say, 5 years. So it will give me 5 year of coupon payment, right? It will give me 5 year of coupon payment. Okay, let's say how much? The par value is 100 and the rate of interest is, let's say, 6%. Okay, so 6 into 100, 6. So 6, 6, 6, 6, and 6. And then in year 5, it will redeem as well. Sorry, in year 5, it will redeem at well. And let's say it will redeem at par 100. So we take all the cash flows of the bond. For redeemable bond, we need to take all the cash flows and find the IRR. Find the internal rate of return. You know what is internal rate of return? The return, internal return. What we are looking for, internal return. Find the IRR. You can apply the formula of IRR. Okay, so the KD for the redeemable bond is simply the IRR. So here I can find the IRR. But to find the IRR using the formula, I don't need two different cash flows in the same. Look, I need cash flows in sequence: year 0, year 1, year 2, year 3, year 4, year 5. No double cash flows. Okay. The better way is to use the Excel formula in the exam, or you can use the formula L plus NL over NL plus NH. It's up to you, right? But if you want to use the Excel way, if you will take 2 years consecutively same, it will be wrong. So I need to add the last two together. It will be 106. Okay. So what I will do, this is the interest amount plus the redemption value together, and take market value as a negative. Look, we are finding it from the investor perspective. Look, if I am the investor, you are the investor. So what is the bond value today? 105.9. So you need to give this value to buy it. And then what you will get? You will get 5 coupons of 6, 6, 6, 6, and 6, and you will get 100 back. Now find the IRR, okay, is equal to IRR %. That's the discount rate, 4.7%. That's the cost. So how to find the cost of debt of the redeemable bond? Take the three cash flows. Which cash flow? Market value as an outflow today, interest as an inflow, and redemption value as an inflow, and find the IRR. Okay, now this is what? This is the required return of the investor. What is the cost of debt to the company? Remember what's the formula? The tax. Now include tax saving as well in these interest payment. Similarly, for irredeemable debt, to find the required return, we didn't multiply the interest with 1 minus t. Similarly, we don't do here. To find the required return, okay, we do it. But to find the cost of debt, do one. Let's say tax rate is 20%. Okay. So what I will do, 6 into 1 minus 20, so 0.8. 4.8. It will be further reduced. 4.8. 3.5%. That's it. Now let's try questions from the book first. Okay, so for redeemable debt, okay, as I said, take three things: market price, interest payment, and redemption value, and find the zero NPV. A zero NPV is the NPV where you find the IRR. So just simply you can do it by using the IRR. So we have to take these three cash flows. Please try this question. Nominal value, face value, par value, same meaning. How many years? 5 years. Okay, we can do it very easily. The current market value is 107.59. 107.59 as an outflow today. Then we have 5 year of interest, which is simply 12% into 100. So 12. So 12, we don't need to do after tax, and it will redeem back at what amount? If it's not mentioned, then definitely it's redeemed at, by the way, it's mentioned, redemption at the nominal value. Even he don't mention, we always assume that if it's not mentioned, it's redeemed at par. So in this case, 10% is the cost of debt, because 10% is the IRR you will get over there. Now same, now you find the cost of the company. Now you have to do 1 minus t only, right? So simply here, this thing you will do, what is the tax rate? 30%, right? So into 1 minus 0.3, or you can multiply with 0.7 directly, 6.6%. So the investor will receive 10% return, but cost to the company effectively is 6.6%. That is the way to find the cost of debt of the redeemable bond. Okay, let's try question number 17 from here. A company has issued $200,000 7% debentures redeemable at premium of 5%. On December 31st, 2006, interest is paid annually on the interest on the debenture on 31st December. Okay, so we are doing 17. Currently, it is 1st January 2003 and the debenture are trading at 98x interest. Corporation tax is 33%. What is the cost of debt to this company? So how to calculate? Take three cash flows. What is the market value today? X interest market value today. What is the life of the bond? How much life of the bond is it? Currently, we are on 1st January 2003. And when the bond will mature? How many years? 2003 full, 4, 5, 6, 4 years. Because we are on 1st January 2003. So December 2003, 1 year, 2004, 2 year, 5, 3 year, 6, 4 year. So 4 year to maturity. Okay. So how to solve it? First of all, today I will take it as a market value. Look, the same thing, but I just need to remove 1 year from here because we have only 4 years now. Okay. We have only 4 years now. So what is the market value today? I will take it first. 98 as a outflow. What is the interest amount? Coupon rate is 7%. Par value is 100. So 7% into 100, 7. But do after tax, 1 minus T. Tax rate is 33%. So $7 into $7 into 1 minus tax. 1 minus 0.33. 4.69 is the interest, effective interest amount that you have to pay. That's the interest we have to get every year in year 3 and year 4. Okay, in year 5, in year 4, you will get interest and also you will get redemption amount. How much redemption amount you have to pay? 5% premium. So mean if it's 100, so it will be redeemed at 105. So plus 105. So 6.4% is the answer. 6.4% is the answer here. Yes. This is the way to find the cost of debt of the redeemable bond. Let's move to the next topic. Convertible bond. How to find the cost of debt of the convertible bond now? So what is a convertible bond? It's same like a redeemable bond, but it also has one extra option. What option? Yeah. The bondholder has two choices here, right? What choices they have? Either the bondholder can redeem its money at maturity or will convert its money into the shares of the company. How many shares? It will be definitely written very clearly in the bond certificate. So a convertible bond is same like redeemable bond, but here bondholder have a choice to choose between redemption amount or converted into shares. Now, what is going to be happen? We don't know. What the bondholder will do? They will convert into shares or they will redeem the money. Depends on what benefit he will get if he convert into shares. Look, the method for the convertible debt is same. Same formula. If you want to find the cost of debt for the convertible bond, the same method. But the only difference here is, okay, because it carries same market value, same coupon payment, but at maturity, the bondholder can either redeem the amount or can convert into shares. So we will see which one is likely to happen. Which one is likely to happen, we will use it. If the convertible bond is going to be redeemed, so we will use the redemption amount. If the bond is going to be converted into shares, we will use the conversion amount. How we are going to find? Look, so we have to figure out these two things. Okay, number one, redemption amount. Number two, conversion amount. Okay, what it basically means. Redemption amount and conversion amount. Look, redemption amount will be given to us, right? It will be given to us that what is my redemption amount? Right? It will be redeemed at par or 10% above par, whatever. Let's say redemption amount is 100, right? What is the conversion amount? Examiner tell us, okay, the bond holder has a choice to either get $100 back or have a choice to get 20 shares of 20 ordinary shares of the company. Okay, so the 20 ordinary shares they can get for the company. What is the market value of the share at redemption amount? Sorry, at maturity date. Let's say the market value at the maturity date is 5.5. So what is likely to happen? What is likely to happen? The bondholder will redeem the amount or convert into shares. Of course, they will convert into shares. Investors are rational. So when we have given the choice to the bondholder The bondholder will decide at the maturity date. The bondholder will decide at the expiry date which option is more beneficial for them, right? So if they believe conversion will give them more value because the share price on that particular day at the expiry date of the share is 5.5. So he will say, okay, give me shares. I don't need my money back. Give me shares. Because even if he get the shares, he can sell immediately at 110. So what we will do in convertible bond, simply see what is likely to happen. Here conversion is likely to happen. So we will use it. Conversion value here. That's it. 110. It will state the share price in the bond certificate. Sorry, it will be how many share price? No, how it will stated on the price. The number of shares will be mentioned only. The expiry date will be mentioned on certificate. How many shares it will be offered, it will be decided. The price will not be decided, right? Of course, price is the market demand and supply concern. Yeah. So it is mentioned on the certificate, on the bond certificate, that when the bond will expire, the life will be mentioned here, the expiry date will be mentioned here, and in expiry case, at expiry, what uh, what amount you will get if you prefer to redeem, and how many shares you get, exact amount of shares, 10 share, 15 share, 20 share, it will be mentioned over there, right? And then it's a choice of the bondholder that they decided to go with the redemption or they want to go with the conversion. Let's do this with the help of, okay, I will do this example. So a company has issued convertible loan notes that are due to be redeemed at a 5% premium in 5-year time. Okay. So redemption value is clearly mentioned over there. So in case of redemption, how much you're going to get, how much the bondholder is going to get, 105. Look, par value is not mentioned anywhere, so that means we believe it is 100. Okay, let me do it. So if investor want to redeem, how much they will get? 105, right? 105. Okay, find the conversion amount as well. The coupon rate is 8% and the current market value is 85. Alternatively, the investor can choose to convert each loan note into 20 shares in 5-year time. So expiry of the bond is 5 year. The bond will mature in 5-year time. So what investor have a choice to get either $105 cash or get how many shares? 20 shares of the company. Okay, the company's tax pays tax at 30% per year. The company shares are currently worth $4. This is the price of our company one share today. Okay, so in this case, if the investors are going to get how many shares they're going to get? They're going to get 20 shares in 5-year time. Not now, right? Not now. They're going to get at expiry, meaning in 5 years time. So that means 20 shares worth of one share is $4, but this $4 worth is today worth. Okay. The price of our one share is $4 today. It's not after 5 years. So we need to find the price of our share after 5 years. Look, he mentioned their value is expected to grow at a rate of 7% per year. Right? So simple formula we have to use. The current price of share is given, multiply with 1 plus g raised to power n to find the value after n years. N mean number of periods. So how many years after we want to find? We expected that the price of our share will grow with 7% every year. Okay. So in that case, the current share price is $4. Okay. So $4 into what we expected, 7% growth we expected for the coming 5 years. So what it gives me? It gives me the market price of our share at maturity that we're looking for. And when we find it, we multiply with our number of shares. So by the way, we can drive a formula, and here we put R. R means number of shares. So how many number of shares? There are 20 number of shares they are going to get. That will give you what? Conversion amount. Amar, understand? So basically we will find the price at maturity, our share price at maturity, multiply with the number of shares at maturity. Okay, so I can do it step by step as well, or I can do it directly here. Look, I am doing here directly using the Excel sheet here. Okay, so first of all, find the market price after 5 years. So $4 is the current market price, $4 into growth 7%, 1.07 power 5. Okay, that will tell me what? The price of the company share after 5 years time. How much it is expected? 5.61. But how many shares they are going to get? 20. So multiply by 20. So that means if the bondholder decided to convert this bond into 20 shares, how much worth they will get? 112. So what they will prefer? Definitely they will prefer to convert this. Okay, so first of all, you have to take the conversion value, redemption value, and pick the higher of these two to add in this format. Because now we believe that investor is going to convert in this case. Okay, next thing is same now. Today market value is 85. So 85 we will use as an outflow today. Interest coupon rate is 8% into 100. So $8. Yeah, don't, because what we are going to find? We are going to find the cost of debt or the post tax. So don't forget to do 1 minus T. So 8% and tax rate is 30%. So 8 into 1 minus T or 0.7, same thing, 5.6 is the interest payments you have to made every year. How many years? 4 years. And you will get conversion value at the end everywhere at the end as well. Okay. Yeah. So I add both of them together because I'm going to use the formula of IRR. Right? A very high value, 13.2% is coming. Mhm. Very high rate, but I think so. That's the way. Let's check the answer for this. Yes, 15. It's 15, yeah. 11.4%. You got 11.4%. Okay, 85, we also use 85 as outflow here. 5.6, we also got 5.6. No problem in it. And 112. Yeah, same thing we did. 85, 5.6, 5.6. Ah, okay. It's 5 years. I took 4 years. Why? Yes, 5 years. Yeah, that's the mistake we made. So basically, we have to add one more year here. Okay. Yeah, no, it's correct. 11.7%. Yes, approximately same. 11.7%. Yes. So it's very important that whenever you're going to find the cost of debt of redeemable bond or convertible bond, select the maturity date, the timings, life, years. You need to select all of them very carefully in the Excel. You can try this. Okay, so how we will do it? Should I do it? Tim, you're trying there? No, you don't. No problem. But you understand, right? Okay, so it will redeem at premium of 10. So it's either redeem at 110 redemption value and conversion value. If I want to get what's the market value today, 4, same growth with 3% for 4 years. So 4 into 1.03 raised to power 4. 4 into 1.03 raised to power 4. And how many shares has been offered? 25. Multiply by 25. Okay, conversion is still expected. Okay, so market value today is 95 and coupon is 6. 95, coupon is 6. What is tax rate? 26%. So 1 minus 0.26. Yeah, 7.8%. Okay, it's 4 years. Okay, just remove one of it. 8.7%. That's it. Okay, that's it. That's how to find the cost of debt of a redeemable bond or convertible bond. Let's move on. How to find the cost of debt of non-traded debt or bank loan? What is non-traded? Any kind of debt which is not marketable. Look, bonds are marketable. It is trading on the stock market. But bank loan is not a marketable loan, right? It's a privately loan you take from the bank. So it has no P naught, no P0. So simple, how to find the cost of the company? Interest into 1 minus T, simple and straightforward, very simple. Mean to find the cost of debt of a bank loan, take the interest and multiply with 1 minus T. Look, let's look at this example. A firm has a fixed rate of bank loan of 1 million, charge 11%, tax rate is 30%. So 11% into 1 minus tax rate. Simple. That is the cost of debt of the bank loan. Okay. And the last thing, how to find the cost of debt of the preferred stock or the preference shares. PD of the preference shares, or we can call it KP as well, cost of preference shares. So look, very simple. If you want to find the cost of the preference shares, right? So preference shares carry a fixed dividend, right? It carry a fixed dividend. So, but fixed dividend you will pay in perpetuity. So simple formula we are going to use to find the cost of the preference shares is equal to dividend the price. It's same like dividend valuation model. But here, look, you will pay fixed dividend. There's no growth in dividend, right? Don't do 1 plus G here. There's no growth in dividend. Preference dividend, we pay fixed dividend. And this is not tax deductible. Don't make a mistake of multiplying with 1 minus T. No. This dividend is not tax deductible. So just formula is D0 over P0. Mean current dividend over current price of the preference shares. Which price? Ex div price. Okay. But once again here, D0 mean dividend amount, interest amount. And how you will find out? Simple. Again, you have the par value. So you have to multiply the par value with the dividend rate, coupon rate, whatever the rate you have. And par value for preference share is not always 100. He will specify maybe $1, maybe $5, maybe 50 cents. So take it very carefully. Look, here he said $1. So that means par value is $1. What is the rate? 9% is the rate. So here dividend is not 9. Here dividend is $1 into 9%. I think you will get how much? 0.01 or maybe 0.001. I don't know. But whatever answer you will get, here $1 into 9% divided by the X interest market value 1.4. That will give you answer. Try that. The answer should be 6.4% approximately. The cost of the preference share is 6.4%. Okay, so this is the way to find the cost of debt. We understand how to find the cost of debt of all of our securities, to find the bank loan, to find the bonds, to find the preference shares. Okay, one more thing is maybe he will give you a variable bond as well. Maybe he give you variable bond as well. So, by the way, in variable bond case, what's a variable bond? A bond where the interest rate vary, the coupon rate vary according to the market rate, right? I mean, what is the market rate? You will get the same. So, what is the cost of debt of the variable? The market rate, right? The market rate. So, the market rate will be given or somehow we have to calculate, and the same we are going to use as a KD.